A very good morning. My name is Johanna Treeg. I'm Politico's economics correspondent based in Frankfurt. In our first panel discussion this morning, we will discuss one of the most pressing issues in the post-COVID era, that is inflation, which has caused a massive cost of living crisis and forced central banks to raise interest rates aggressively, which has also contributed to the latest turbulences on financial markets. Before we discuss a couple of housekeeping rules, you can only ask questions via the Swapcard platform, which you can find on our event website. If you're already on the Swapcard, please feel free to chat with fellow attendees and ask questions in the box either below the stream or next to the stream. If you're here in the room, you can ask questions by scanning the QR code that is rotating on the screen. Let's kick this off. A very warm welcome to all of you again from my side. With me here to discuss, Johan van Overveld, who is a member of the European Parliament and its Committee for Economic and Monetary Affairs. He's joining us online. Also, Alfred Kammer, the director of the European Department for from the International Monetary Fund, who's joining us from Washington, D.C. So he's either staying up very late for us or got up very early. A special thanks for that. And last but not least, with me here on the stage is Yanis Stounaras, the governor of the Greek Central Bank and a member of the European Central Bank's Governing Council.
Morning.
Welcome to you.
Thank you.
So the ECB has raised interest rates quite aggressively since last summer, and you continued that rate cycle last week, even as there were turbulences on the financial markets. You were one of the few people, Governor, who even before these turbulences warned that maybe now is the time to slow the tightening. How has the recent episode changed your assessment, if at all? Do you think now it's actually time to stop? Or could you please elaborate on your concerns today?
Well, good morning, first of all, and congratulations for this event. I think recent events imply more tightening. Banks have become or will become more conservative. That means that, let's say, 10 basis points of tightening before this banking event that happened in the United States and in Switzerland is not 10 basis points now. It's higher. So we have to take this into account.
Does that mean that you think we should pause tightening now, or are you sticking to your slower increases?
As I have said before, we should make no pre-commitment. I'm glad that we decided in our last meeting that we'll give no forward guidance. So meeting by meeting approach, data-based, and this is what we're going to do.
And what is your concern right now over tightening? Are you concerned about troubles on financial markets, or is it more about the economic prospects, or is it?
Okay, first of all, inflation still remains high, much higher than our target, but it is declining. You remember when we had an interview together in the beginning of November, then we had the September forecast. I had told you that in my view, inflation will fall. It actually fell. It's high, but it is declining, mostly because of gas prices falling, oil prices falling, but we don't need to be shy about that. It was, after all, gas prices which skyrocketed, which created inflation. In Europe, inflation was mostly supply side, and this differs from the United States. So inflation is falling. GDP growth is perhaps better than we expected, but it's still weak. The sacrifice ratio is quite high. That is for some basis points reduction of inflation, the reduction of GDP growth is much higher. So what we used to call in the past sacrifice ratio is high. Then we have this banking turbulence. which we welcomed the authorities both in the United States and in Switzerland for a very swift action. But I'd like to quote Aristotle here, who said that sometimes the whole is bigger than the sum of its parts. So, okay, you had some problems in one bank in the States, another bank in the States, one big bank in Switzerland. The authorities intervened, but we should not forget that financial crisis might spread very quickly, like fire in the wood, so we have to be careful here. So it's both macroeconomic developments, but also financial stability that make me feel that we should be prudent, more prudent than before.
Mr. Van Overveld, do you acknowledge these risks described by the governor? Do you think it's maybe time now to pause in this battle against inflation?
Well, first of all, thank you for having me, and a very good morning, very early morning to Mr. Kammerer, but good morning to all the others. Of course, the governor is right, Governor Sturnas, that we are in the midst of some turbulence. But there are several points he made with which I don't agree. Inflation is falling if you look at headline inflation, but of course core inflation is rising, it's still rising, and more is to be expected there if you look at what's happening to labor costs. So I think a pause in the fight against inflation would be a real mistake. For those of us who lived through the 70s should realize that that kind of stop-go policy is not what you should do. If you don't kill the inflation beast, if I may use that word here, now and here, then you will have to do it later. But later, the cost will always be larger than now. Does that mean that we have to be reckless in terms of interest rate rises? No. But I think what the ECB did and what the Fed did yesterday were very good decisions to keep on moving interest rates in the right direction in order to fight inflation. And of course, the fact that interest rates have to be pushed up quite drastically now has a lot to do, I'm sorry to say, that certainly the ECB, but even also the Fed, came into the game too late. It was only in July that the ECB started to raise its policy rates, whereas it was already months earlier very clear to some of us that this inflation problem was much more serious than many thought at that point in time. And of course, the ECB and other central banks have still their options to intervene when financial stability requires it to do. Like, for example, the British, the Bank of England did last autumn when there was a lot of commotion in the financial markets there. But I think they should look very carefully at the way in which they can sterilize intervention at this point in time. If intervention is needed in certain markets, it has to be done. But this intervention, given where we are, in terms of financial conditions, should be sterilized in terms of other posts on their balance sheet. Nobody less than Mr. Nagel of the Bundesbank said a few days ago that there are 4,000 billion euros excess liquidity in the market. 4,000 billion euros excess liquidity in the market. It's no wonder you have inflation. It's no wonder that you have or you had many asset bubbles. So no, we should stay the course. We should do what is needed to bring inflation under control here and now. And of course, central banks should remain alert to what is happening in the financial markets, and they can do that.
Thank you very much. I mean, I think what your comments suggest that you think it is quite possible to address price stability and financial stability with different instruments. Is that something that you agree with, Mr. Kammer, or do you think that there's actually a trade-off that we are facing today, where if you rise interest rate too aggressively, we do risk financial stability, and that would call for more caution?
Thank you very much, Johanna, for this question. I agree fully with that. The focus still needs to be on inflation. While headline inflation has been coming down, core has not, and core has the price of being much more persistent. And we expect also that core will come down slower and will remain more persistent because energy and food prices need to percolate, and they will percolate through prices. And that is something to watch. And we see super tight labor markets where labor costs and wage pressures will still need to play a role. And we need to still be concerned about the anchoring of inflation expectation. And under these circumstances, central bank need to focus on bringing down inflation. We know that the costs of doing too little outweigh the costs of doing too much. So when you're doing about looking about a risk management approach with upside risks to inflation, then these risks call for being very vigilant on the inflation side. On your question, central banks have a monetary policy tool as a tool to focus on achieving the inflation target. When it comes to financial stability risks, they have a set of tools in order to deal with those. But in the act, of course, is what we are going to see right now. When you have some financial market turbulence, what you would expect is that financial conditions are likely to tighten. And under those circumstances, that is, of course, something central banks will need to take into account when they're discussing and when they're deciding about future rate hikes. That calls for, as we have been all saying all along, a data-dependent approach, a meeting-by-meeting approach. First of all, we learn with every data release. We have been finding out that inflation has been more persistent. We need to take these things into account. And of course, we also need to understand how monetary policy affects the transmission to economic activity. And that means with every meeting, central banks will need to take a stock on where we are, and then need to take current conditions into account in order to make a judgment whether their monetary policy stance will achieve the inflation target over the next, over the medium term, their forecasting period, 12 to 18 months. But what is clear right now is inflation remains a key problem, and the focus of central banks still needs to be on that.
Governor Stonaris, do you agree that it is so easy to sort of separate financial stability from price stability and, the interest rate tools from liquidity tools? Or is that maybe the interplay a bit more complicated than our panelists have suggested?
Before I answer your question, just my observation in some of the comments made already from my colleagues online. First of all, we didn't start tightening in July 2022. We started in December 2021 when we announced the pause of net purchases under both PPP and APP. So we sent a signal to markets that we started tightening. Second, our target is not underlying inflation, it's headline inflation. Headline inflation is falling, and studies in the ECB shows that when headline inflation falls or rises, then underlying inflation falls or rises with a lag. So the important thing is headline inflation. Now, to your question, when things are normal, yes, we can say that we can separate completely price stability and financial stability, and with separate instruments. But when there's turbulence, okay, we have to be more careful here. I wouldn't say that there is a trade-off, but we have to tread on a thin line. So I would be careful to use the expression that it can be separated completely. For instance, the Eurozone. The Eurozone still is a perfect monetary union, but it is an imperfect fiscal union and imperfect banking union. I remind the audience here that we still don't have a European deposit insurance scheme. We still don't have a crisis management framework which is unified across the continent. So that's why, for instance, we use flexibility. We voted unanimously to have a transmission protection instrument in the ECB. So all these show that we have to be careful. Yes, when things are normal, the two things can be separated completely, but when the situation is not fully normal, then we have to be careful.
I mean, sort of irrespective of how much further the ECB might have to go in terms of battling inflation, I think it is clear that, you know, the more aggressive you go, the bigger the risk for banks will become as well. So I wonder, perhaps you could start on this, Mr. Kammer, what other agents could do, especially European governments. Do you think it's now time that the focus is shifted on them? What role do they need to play?
Yeah, I think we have been arguing for a while that fiscal policy should be aligned with monetary policy in order to support the disinflation effort. I should say fiscal policy stepped in rightly with focusing on protecting the population from the cost of living crisis, which was caused by Russia's invasion of Ukraine and the huge increase in energy and food prices. Now is really the time to pare back these packages, focus on and make them targeted only to the most vulnerable, and phase them out as energy prices are going to decrease over time. That will help in terms of putting less pressure on aggregate demand. That will help with the disinflation effort, which is undertaken by a central bank. And clearly, that will allow the central banks to have a more benign hiking path than otherwise if fiscal policy would be more expansionary. It is also good then for the costs of servicing the public debt. So bottom line is, on conjunctural reasons, fiscal policy should be pared back with phasing out these packages as the cost of living crisis is going to slow down. I should also mention for the medium term, it's very important to also understand that fiscal policy needs to have the firepower to step in when and if required. And we know that shocks are going to hit the economy all the time. And for that, you need to build up fiscal buffers over the medium term. And that, again, by focusing on essential spending, you're creating room for future investment, but you're also creating these buffers to, again, step in forcefully when needed, and the shock arises, and there's a demand on fiscal policy.
Could you just give us a very short assessment on how well European governments are doing in your assessment on this front? Are they following your recommendations?
I would say the intervention in the last year was very forceful, focusing on maintaining or achieving energy security and undertaking the policy measures there. The focus on the cost of living side, we would say could have been more targeted. There should have been also less intervention that impacts the price signal. So that is something which now, when energy prices are lower, governments really need to focus on, because when too much money is going to large parts of the population who don't need to be protected from the rise in cost of living, that makes it more expensive for the budget, that it's less efficient. And in our view, definitely more can be done in terms of making these energy packages targeted and over time start to phasing them out.
Do you agree with that assessment, Governor Sanaras?
Yes. I think fiscal policy should be aligned with monetary policy. I have to observe that since the end of the pandemic, fiscal policy is being tightened despite the, I mean, we talk about the deltas, the differences in the primary surplus, the adjusted primary surplus. So we cannot say that fiscal policy has contributed to inflation, but definitely fiscal policy has to be aligned in these difficult times with monetary policy. But I could say also that energy policy plays a role here. And I think we welcome the decision of the European Commission to change the way that the pricing of electricity was taking place before. We didn't need to pass on the retail prices or the wholesale price that has been affected by an imperfect energy gas market because of the war in Ukraine and because of the cuts in gas supplies.
So are you happy with the current fiscal stance generally, or do you think more needs to be done?
Well, anyway, from next year, there's going to be a new Stability and Growth Pact, and we'll come back to more normal conditions. But I think it was good that governments intervened both in the pandemic and in the energy crisis. We insist, in the ECB, in the 3 T's. That is, fiscal intervention should be targeted, should be tailored, and should be temporary. Not in all cases we observed the simultaneous achievements of the 3 T's, but more or less, so far, it has been okay. But we have to be more careful since the beginning of next year.
Mr. Van Overveld, could you sort of give us your impression from Brussels? Is that message for the need for aligning fiscal policy with monetary policy, is that resonating in Brussels and the finance ministers that you speak to?
Well, I mostly agree with what the 2 other speakers have been saying about the necessary alignment between fiscal and monetary policy. There are a few things that I think we should keep in mind given the present situation. And that is, for example, with respect to Europe, we're in full implementation, like Commissioner Gentiloni outlined in the session before this session, of executing the Recovery and Resilience Facility, which amounts in total to 735 billion euros, which still is a considerable amount. We're absolutely not yet at the limit of this program. On the contrary, we're executing this. And this is, of course, putting extra demand into the economy. And there are already clear indications that in certain markets, in certain countries, these additional investments or this additional demand into the economy is contributing to inflation. So I think we should take the opportunity, given this input of money into the economy through the European channel, that individual countries should start looking more closely at their individual fiscal position and reassure their long-term sustainability of that debt, which for some countries is, let's say, under some pressure. So this realignment or this alignment between monetary and fiscal policies should certainly be more intensified. And there was already a reference made to the Growth and Stability Pact. I think it's fairly obvious that with respect to the new rules that are now under development, that they should first of all aim at keeping that long-run sustainability of the debt situations of individual countries under control, because that would certainly be an issue within what Governor Stournaras called the perfect monetary union and the imperfect fiscal union, will lead to a lot of pressure if we do not succeed in reducing tensions on emanating from the debt position of certain individual countries.
Thank you very much. I would like to stay with you, Mr. Van Overveld. Another element of the ECB's policy is the reductions of its bond holdings. And so far it has announced fairly tepid plans to reduce those holdings by about 15 billion a month. You have in the past called for a more rapid reduction of those bond holdings. Has the recent turmoil on financial markets changed your assessment on that? or do you still push for a faster reduction?
No, I have not changed my point or my position on that, because as we said earlier in this discussion, or at least two of the three participants in this discussion, that the fight against inflation is still of primary concern. And of course, there is what I define as a monetary overhang in the economy, the 4,000 billion euros of excess liquidity sloshing around in the markets that needs to be reduced. Otherwise, we will keep on going from one asset bubble to another, and we will never get this good old inflation, between brackets, in terms of goods and services, under control. And crucial in that respect is indeed the bringing down of the balance sheets and keeping at least the pace that has now been announced, 15 billion euros a month reduction in the balance sheet. If the analysis is correct, like Mr. Nagel of the Bundesbank put forward a few days ago, that there is 4,000 billion euro excess liquidity in the market, and you reduce it by 15 billion a month, everybody can calculate that it takes you 22 years to get that excess liquidity out of the system. That's of course a kind of oversimplistic calculation, I know very well, but I think in a measured and thoughtful way, keeping focus on reducing that balance sheet as the circumstances allow is something that needs to be done. And the present financial turmoil should not be a reason to walk away from it.
Governor Stonaris, what's your position on that? I mean, I guess the counter argument would be to say, you know, we are in a very uncertain environment. We've got war on the region's borders. The economy isn't doing fantastically, and you have interest rates to fight inflation. So why would you want to do quantitative tightening, which is something that you have very little experience with? So, I mean, is that sort of, would that be your counter argument, or would you actually say this is a good time to accelerate the reduction?
Make my position clear. Inflation still remains a problem. It's much higher than our target. It's falling. Now, on liquidity, we should not forget that 2 years ago, broad money supply, M3, was growing at 13% a year. Now it's growing at only 3% a year. So we have already observed a big reduction in the liquidity position in the economy. Second, we should not forget that we have already tightened our balance sheet much more than this 15 billion a month that started in March, because TLTRO has been repaid in a very dramatic pace. So we have already started tightening our balance sheet. QT has started with TLTRO. Why do we keep TLTRO out of the picture? So we have to be careful, because QT implies more monetary tightening. So we should put together interest rate hikes and QT. Of course, we have to bring down, definitely, these huge assets that we have created during the crisis. But we should do it in an orderly way. We shouldn't need to rush. There is no reason why the horizon is limited here.
Mr. Kammer, in your view, what role does sort of concerns about a possible return of a sovereign debt crisis have to play in the ECB's consideration when discussing its balance sheet?
Yeah. It's I think important that the size of the balance sheet of the ECB is going, and of other central banks, is going to be reduced. I agree with others, with Yanis, that should be a gradual and predictable approach to reducing the size of the balance sheet. The footprint of central banks in financial markets through that is just too large. Where we need to be careful, of course, is we understand very little in terms of what quantitative tightening is doing to financial transmission, monetary transmission, and what kind of impact it has on the financial functioning on the financial markets. And therefore, at this stage, it has to be a learning by doing approach as we generate information on quantitative tightening. And that calls for focusing as the main instrument right now using interest rate policy in order to affect monetary conditions. But as we learn more about quantitative tightening, of course, this view can change. When it comes to the impact of all of this, as I said already, central banks need to be concerned about the functioning of financial markets. They also need to be concerned about the possibility, as part of the normalization process, that spreads in sovereign debt instruments may widen. And that implication of a widening of sovereign spreads of course, could have implications for the transmission of monetary policy. It would mean that in some countries, bank funding costs would be higher than in others, and that would make the monetary policy stance more contraction in some economies than in others, and that is very undesirable. And we have seen that the central banks are very careful about that. The ECB has been using PEP in order to address some of these problems in the first normalization space. And they have developed, as Yannis pointed out, the TPI, which could come in should there be disorderly market developments, just in order to make sure that monetary policy transmission is going to be effective and is affecting all economies equally, and not leading to a situation when spreads widen, bank funding costs in certain economies increase more than in others, that the monetary policy stance becomes much more contractionary in those economies, which would be undesirable.
Thank you very much. I have to be very mindful of time already, unfortunately, but I would like to ask you all a final question. Former Bank of England Governor Andrew Haldane recently suggested that considering the costs associated with achieving the inflation target and the cost associated with not achieving it, the best way forward might be to temporarily lift the target. Could I have a very quick round of all of you, like what you think of this proposal and whether that might be worth considering? Maybe you can start, Mr. Kammer?
Yeah, I don't see how this would be desirable, because whenever you change the target during the fight of bringing inflation down, you risk losing credibility. And when you risk using credibility, you risk a de-anchoring of inflation expectations. And we know that if this were to happen, that it will be costly to bring down inflation. Interest rates hikes would be higher, economic activity would be more affected. So that's in a nutshell.
Thank you very much. Mr. van Overveld, what's your position?
I've not been in favor of this inflation targeting from the beginning. I'm totally in line with the late Paul Volcker, who always said, why in hell 2% and not 3% or 1%? Especially when you know how much deviation there can be between these numbers and the reality of price increases. But we have it now, and I don't think that at this point in time, stepping away from the 2% inflation target would be a sensible thing to do. Like Mr. Kammer said, it might increase uncertainty, it might de-anchor inflationary expectations, it might have a lot of negative consequences for the financial system and for the economy. But I think we should rethink at a moment. Hopefully, we once go into more easy waters with financial and economic developments. I think we should very carefully think about the principle of inflation targeting in the way we have been doing, whether that makes sense to continue. But at this point in time, it would be counterproductive to do that exercise.
Governor Stenaris?
With this article, Mr. Haldane, which I read it, if I remember well, at the end he does not actually propose this. He just refers it as one option, but he doesn't opt for this. I think he says extending the horizon of adjustment, which I fully agree. So to be fair, I think he doesn't propose it as an optimal solution. I agree with my colleagues online that we should not change the inflation target now. This could be a very nice academic discussion in universities, but not in the Eurozone, because as you know, there are countries where the anti-inflationary DNA is very, very strong because of the past, because of history. So if we do that, we're going to create a mess, and it's not the right time. Perhaps when we achieve our 2% target today, then yes, maybe. But for the moment, let's keep it an academic discussion, not put it in the policy-making discussion. It could be dangerous.
Fantastic. Thank you very much. So I guess to sum up, there's some disagreement about the ideal policy path ahead, both on interest rates and possibly the balance sheet, but a firm agreement that we should still stick to the target and that governments should also play their role. Thank you very much to the panelists for this very interesting discussion. I would also like the audience for listening in and ask attendees in the room to stay seated as our next session is going to start immediately. It will be a discussion on the retail investment strategy, the next building block for the Capital Markets Union, moderated by my wonderful colleague, Hannah Branton. Thank you very much.